In this video we are going to talk about dividend stocks from China. So before starting, please like this video and subscribe to this channel for future updates. Chinese companies are recognized for their turbulent growth and high prices, but not so much for providing consistent dividends. Some beaten-down energy and real estate equities will jump to the top of the list if you search for Chinese dividend stocks. For income investors, many of those high yielders are still too volatile. Rather, investors should focus their attention on China's tech and telecom industry, which is full of well-established companies that provide consistent dividends. Let's look at three of my personal favorites: China Mobile, NYSE, CHL, Lenovo, OTC, LNVGY, and NetEase, NASDAQ, NEAT, NASDAQ, NetEase. Number 7. Li Auto Stock. Li Auto is one of numerous Chinese electric vehicle manufacturers doing business in the United States, competing with Tesla and others, TSLA. Li Auto has achieved enormous sales growth from its one current vehicle, the Li 1 SUV, despite the fact that company is still losing money. The Li 1 is a hybrid vehicle with a small gasoline engine that extends its range. On October 1st, the company announced that 7,094 Li 1 subs were delivered in September, jumping 102.5% from a year before. However, this is a decrease from July and August. Despite the chip shortages, Q3 deliveries totaled 25,116, exceeding a lower projection. Early next week, Li Auto will most likely release October sales. Li Auto shares plummeted to 15.98 in May after a massive run from its July 2020 IPO to a record 47.70 on November 24, 2020. On July 1st, the stock more than quadrupled to 36.66, but has since retreated, as have other EV stocks and highly valued growth names in general. Within that bigger consolidation, shares have created a bottoming base with a 36.76 purchase point. On October 7th, Li Auto stock rose over its 200-day line, and on October 14th, it reclaimed its 50-day line, adding to gains on October 15th. Li Auto broke a downsloping trend line on October 25th, providing another early entry as it nears a formal breakout. Number 6. BID Stock. BID Company is China's largest pure-play EV manufacturer, producing electric vehicles, buses, and a variety of hybrids. It's also a major producer of electric vehicle batteries. Berkshire Hathaway, BRKB, led by Warren Buffett, has been a long-term investor. In stark contrast to Li Auto, NIO, and SPEV Motors, BID is profitable. BID's third quarter profit decreased year-over-year, despite moderate revenue growth. BID's new energy vehicle sales increased by 294% to 183,000 in the third quarter, while EV-only sales increased by 186% to 91,616. However, because many of these vehicles are replacing gas-powered vehicles, overall delivery increase is not nearly as strong. BID, like NIO and SPEV, has started selling electric vehicles in Norway, beginning with the Tang SUV. BID stock has dropped roughly 52% from its January high of 35.94 to a low of 17.41 on May 12, a lesser drop than Li Auto stock. In late July, BID shares rocketed above a handle buy, almost reaching a record high before falling down. With a 35.35 buy point on October 15, shares broke out of a double bottom base and continued to rise. However, following the release of the Q3 EPS report on October 28 and 29, shares fell back into the purchase zone. BID is a Hong Kong-listed company that trades over the counter in the United States. As a result, the BYDDF stock chart has a lot of small gaps up and down. Number 5. SPEV Stock. The G3 small SUV, the P7 sedan, and now the smaller P5 car are all produced by SPEV. The P5 sedan, which went on sale in mid-September, is the first production vehicle to include LiDAR. In September, SPEV sold 10,412 electric vehicles, up 199% from a year ago and also up from August. 7,512 P7 sedans, 2,656 G3 and G3i small subs, and 244 P5 small cars were among them. In November 2020, SPEV Stock reached a high of 74.49, nearly tripling from its IPO price. In May, the stock dropped to 22.73. SPEV Stock, however, produced a bottoming base with a 48.08 purchase price after gaining for a while. On October 13, SPEV Stock surpassed its 50-day and 200-day moving averages. On October 15, the stock of SPEV soared, breaching a trend line in its consolidation and providing an aggressive entry point. Number 4. SOHO Stock. The Chinese mobile game company was one of the first Chinese internet companies to go public in the United States, doing so in July 2000. SOHO's stock peaked in 2011 and steadily declined until March 2020, when it made a major comeback. For over a year, the stock market has been consolidating. SOHO stock soared further on July 13, clearing an early entry, or base within a base, and approaching a 52-week high. Shares quickly fell, along with other US-listed Chinese equities, last week. SOHO is profitable again after several years of losses, with revenue growth picking up. SOHO announced a per-share profit that was greater than predicted on August 9, with revenue jumping 27.5% to $204 million. SOHO now features a 24.60 entry cup with handle base. The handle is unusually long and slender. Stocks have risen over their 50-day moving average, adding to gains seen on October 20. However, on October 22, the stock slipped below its 50-day moving average. Number 3. The Skyline of Shanghai, China. With 863 million wireless users, 583 million of whom have 4G plans, and 90 million wireline broadband customers, China Mobile is the country's largest telecom firm. The Chinese government backs China Mobile, as well as its two smaller competitors, China Telecom and China Unicom. Analysts predict China Mobile's revenue and earnings to rise 4% and 6% this year, respectively, as the company expands into rural areas, upgrades 2G/3G subscribers to more expensive 4G plans, and expands its wireline operations. China Mobile is trading at approximately 14 times profits, compared to a telecom industry average of 22. China Mobile distributes semi-annual dividends based on its earnings growth, which are reported every half year. Its trailing yield has remained between 2.75% and 5% for the previous 5 years, making it less predictable than its Western peers. The payout ratio of 43% readily supports its present yield of 3.3%. Number 2. Lenovo. Lenovo is the world's largest PC manufacturer. Company PC and smart devices sector, which sells PCs, 2-in-1s, and tablets, accounts for the majority of its revenue. In recent quarters, that company has grown year over year, owing to increased demand for high-end laptops and 2-in-1 devices. Lenovo's mobile division, which offers Lenovo and Moto devices, is struggling in China's saturated market, but rising in other regions such as Latin America. However, due to macroeconomic problems and poor enterprise expenditure, its data center income remains a dead weight. Analysts anticipate Lenovo's revenue to climb 2% this year after compensating its flaws with its strengths, while its earnings will remain constant. Lenovo also distributes semi-annual dividends, which are announced every 6 months. The company's current yield of 5.3% is approaching a multi-year high, but that's mostly due to weaker PC sales, which have caused the stock to plummet 25% in the last 5 years. However, that dividend is backed up by a 70% payout ratio that is sustainable. Lenovo isn't a high-growth stock, but it trades at just 13 times earnings, significantly below the industry average of 21 times earnings. Number 1. NetEase. NetEase, which publishes video games, develops mobile apps, provides online services, and operates the e-commerce site Kaola.com, is a good option for investors seeking for a higher growth stock that nevertheless pays a dividend. The majority of NetEase's revenue comes from PC and mobile games aimed at Chinese gamers, although it also licenses hit Activision Blizzard games. NetEase's revenue from PC and mobile game titles increased by 62% last year, accounting for 73% of its total revenue, led by homegrown franchises such as Fantasy Westward Journey and Tianxia. NetEase's revenue and profitability are expected to increase by 40% and 22%, respectively, this year, according to analysts. On this enthusiasm, NetEase's stock has already risen 85% in the last year, but it still trades at just 22 times earnings, compared to the industry average of 35 for internet information providers. Quarterly dividends are paid by NetEase, however they fluctuate depending on seasonal earnings growth. However, since it began paying quarterly dividends in 2014, NetEase's dividends have increased every year on an annualized basis. Its 1.4% forward yield isn't very outstanding, but its low payout ratio of 23% leaves lots of space for future raises. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.